Okay, well, good morning if you're on the West Coast. Good afternoon if you're on the East Coast. If you're somewhere in between, good day to you as well. Thank you for joining our One Big Beautiful Bill webinar hosted by our team here at Hito. We're excited to have you with us today. Um, we want to first get into seeing where everyone is joining us from, and I want to add that to the chat. So if you would open up the chat and just tell us what city you're joining us from. We'd welcome to see where you're joining. So we have a couple coming in, maybe. Um, Personally, I am on the East Coast. We got Kansas City here. Okay, Newport Beach. Thank you for joining. Thank you for joining. Personally, I'm on the East Coast here. My name is Josh Simpson. I'm your facilitator for today's webinar. Again, we're excited to be here, have a packed virtual house. But first, let's get into a few notices. First, what would like to share is that this information shared today is more general. Rick, if you could move to that next slide for us. This is more general information. If you want anything specific or have questions about your business in particular, please consult Hito or your tax advisor. We'd be happy to have that conversation. Here's our agenda for today. So we have our Hito and speaker introductions, business changes, research and development expenses and credits, and a Q&A session today. Um, We'll have a few interactive polls along the way. Overall, our objective is to highlight updates from the One Big Beautiful Bill, provide clarity, and ensure you can take actionable steps towards positive business outcomes. So, again, my name is Josh Simpson, but who is Hito? We have people joining us from all over. So, we want to share a bit about our firm. We're a tax consulting firm specializing in federal and state credits and incentives. We also help growth companies secure funding, tax grants, tax abatement, exemptions, along with a few other consulting services. There's a few case studies as well I just want to share to maybe give insight into a few of the industries and companies we work with. One would be this aerospace manufacturer, and I like to highlight here 2.7 million in R&D tax credits for this particular manufacturer who has grown substantially while working with us. Also want to highlight semiconductor manufacturer as well. And what I'd like to point out there is 32 million in total savings and grants. So just wanted to give you a framework of who we work with, as well as a few other industries that we'll get into today with our lineup. Um, so again, I am a business development manager here at Hito, as well as again your facilitator for today. My background is in accounting and finance, and have been in the industry a while. Glad to be here with the Hito team. Joined early Q2. I also will be accompanied by Yuko Tsushita, who is our managing director and founder at Hito, and as well as Josh Kane, who shares not only a name with me, but is one of our subject matter experts here as a tax manager. Now, before I pass to Yuko, who will be covering our notable business changes for this session, let's first move into our polling question to kick us off. I promised some interactivity. So, how do you anticipate your business will be impacted by One Big Beautiful Bill updates? So, number one, may need to go back and amend returns, which is certainly possible. Number two, will likely move forward with any new provision or incentives. May need to implement some new tax strategies. Or number four, I am not sure. A few more seconds here to cast your vote with us. All right. Thank you for answering those. Now we'll move into business updates with Yuko.
Awesome. Thank you, Josh. So today, I'll be discussing some of the broader changes impacting many businesses as a result of like recent tax legislation or like one big beautiful bill. While like this is not an entire list of all changes, we had handpicked that some of the credits and update that may benefit our clients. And I will be covering key updates on bonus depreciation, Section 179, and various credit. And my colleague Josh Kang will then dive deep into the important change related to R&D tax credits and Section 174, spending extra time on Section 174 as it is significant impact to many clients who are innovating and taking R&D credits already. Our goal today is to provide clarity, actionable insight to help you understand these changes and how to navigate them effectively. We'll be happy to answer any questions, so please submit your question using Q&A section below. With that, let's get started. So first topic is bonus depreciation. What is bonus depreciation? So bonus depreciation is tax incentive that allow businesses to immediately deduct a large percent of the cost of fixed asset in that year they purchase and start using them, rather than spending spreading costs over many years, typically 5 or 7 years. So the one big beautiful bill permanently reinstated 100% bonus depreciation for property acquired after January 19, 2025. So this is a big deal for a lot of clients who are purchasing large equipment or machineries. For property acquired before this date, the bonus depreciation percentage remained on the previous schedule. So property placed in service in 2025 would be 40%, and property placed in service in 2026 will be 20%. And the bill also introduced a new class of qualified production property that is eligible for 100% bonus depreciation. So what is a qualified production property? It is property for non-residential real property in the US in manufacturing and agricultural and chemical production or certain refinery operation through December 2028.
So, Yuko, before we
Sure.
move into additional updates, if I'm a business leader, what kind of planning should we be thinking about for bonus depreciation?
Sure. So if you're already taxable and you're already thinking about purchasing large equipment or fixed asset, I think now is the time to move forward and maximize full deduction. And before you take any uh, steps, I will always say contact your CPA and talk through this and making sure you can use these deduction or benefits.
Thank you.
Awesome. Let's go to Section 179 update. So what is Section 179? So this is the code section allow tax deduction, allow business to deduct the full purchase price of qualifying equipment and or software purchase during that tax year. This means you can write off the entire cost of eligible asset in 1 year rather than depreciating over several years. The bill permanently increased the Section 179 expensing limit. The new limit is 2.5 million. But there's a caveat. So if company purchased more than 4 million for property in the tax years beginning after 2024, there might be a phase out. So you need to make sure you talk through that with CP as well. And these limitation amount will be adjusted for inflation starting 2026 tax year. Okay, let's go to next slide. So next topic is paid family and medical leave credit. The paid family and medical leave credit is tax incentive for businesses that provide paid leave to employees. It gives employers a tax credit for a portion of the wage paid to employees only. So the paid family and medical leave credit is permanently extended. And for tax years beginning after December 30, 2025, employers can elect to calculate the credit based on applicable percentage of the premium paid for insurance policy that provide paid leave instead of the wage paid to the employee. So prior to the OBBBA change, employer only had an option to compute credit on the wage paid. So that gives a little bit more flexibility for businesses. So the alternative calculation does not include insurance paid due to the state or local mandate. So that's something we need to be careful of. And also to avoid the double benefit, you cannot claim the deduction for the portion of the premium which you're taking credit of. So next topic is employer provided childcare credits. And when it comes to employer provided childcare credit, we are talking about tax credit for businesses that help their employees with childcare costs. This can be done in a few ways. They might be building on-site childcare facility. Second, it would be help pay for employees' childcare costs. Or lastly, provide other related support. The credit percentage is increased from 25% to 40%. And the cap is increased from 150K to $500,000. And with the special provision for eligible small businesses, that cap was increased to $600,000. Okay. Next change was employee retention tax credits. The employee retention tax credit, probably many of you remember during the COVID era. This was refundable tax credit for businesses that continue to pay employees while they were shut down due to COVID-19 pandemic or had a significant decline in gross revenue. The purpose was to encourage businesses to keep employees on their payroll during pandemic. The OBBBA included a partial repeal of the ERC credit, disallowing claim for credit or refund for wage paid after June 30th, 2021. So that would be third quarter or fourth quarter 2021 if the claim had not been processed by July 4th, 2025. So if you still have the outstanding in third quarter, fourth quarter 2021 credits, you may want to consult with people that firm you worked with on the ERC claim. So last one gonna be energy credit. There was a lot of updates around this, so I just wanted to mention. This impact both individual and businesses, so it's crucial to be aware of upcoming deadline. So I will start from credit related to vehicles. So previous owned clean vehicle credit is repealed for vehicle purchased after September 30th, 2025. Similarly, clean vehicle credit is also repealed at the same day. And for businesses, 45 commercial clean vehicle credit is repealed for vehicle purchase after September 30th, 2025. So anybody individual or businesses, if you're considering purchasing clean vehicle, you may want to act now instead of waiting. If you wait till October, you will be not able to take these credits. So next, we have some energy related credits. So next one gonna be Section 30C, alternative fuel vehicle refueling property credit. It's a mouthful. Is being repealed for property placing service after June 30th next year. Next one gonna be energy efficient home improvement credit is repealed for property placed in service December 31st, 2025. And then also residential clean energy credit, and this is not typically known as home solar credit. It's repealed for expenditure made December 31st, 2025. And then last one is new energy efficient home credit. That will be repealed anything acquired after June 30th, 2026. So as you can see, the deadline for these credits are quickly approaching. So we encourage you to consider these dates in the financial planning, especially if you or your clients are already planning purchase a clean vehicle or doing home improvement project.
Awesome. Thank you, Yuko. And those were very notable changes. And if you're anything like me, you waited to the end to take notes. So we'll make sure we get the replay out so you can get that information about bonus depreciation, which is imperative, as well as those deadlines approaching. In layman's terms, what we hear is if you can buy the car now, save money, right? So, great job, Yuko. Let's move into our second polling question. Which of the following best describes your company's R&D activity? So number one, you're developing new products. Two, implementing new processes and testing, exploring new improvement opportunities. Or four, not sure. And if there is a activity that we missed, feel free to put it in the Q&A and we'll make sure we highlight that as well. A few more seconds here to answer. All right. So with that, we have our results here, but with that, we will move to Josh Kane. So I see a few were not sure, but Josh is luckily going to cover the R&D credit as well as some updates to Section 179. And Josh, take it away.
Thank you, Josh. Yeah, so moving on to the R&D expenses and credits. First, we'll go through just an exploration of what that actually is, just so you can understand what the different changes from the One Big Beautiful Bill are. So the R&D tax credit, it's a it's dollar for dollar tax liability reduction credit that the federal government made permanent in 2016. Purposes to incentivize businesses to innovate, develop new products and processes, promote economic growth. The credit, the eligibility for the credit, we're talking about businesses of all different sizes, all different industries. They could all qualify for it, so long as they're meeting a specific test where they're developing new products, processes, enhancing existing products or processes, creating new prototypes, models, conducting technical research, designing new kinds of software, improving existing software. We have a 4-part qualitative test, and then this will be the guideline for how we determine whether or not any kind of activity will meet the IRS's definition of research and development for the purposes of the R&D tax credit. The first one being a permitted purpose, being some kind of a new function, performance, reliability, or quality. The second being an uncertainty that needs to be eliminated during the process of the activity. That uncertainty had to have existed prior to any kind of experimentation continuing, which leads into the process of experimentation. It needs to follow some kind of a scientific and intentional method of testing out what works, what doesn't work. Any kind of systematic trial and error methodology is going to qualify for that. And the last one being the activity must be rooted in some kind of a technical nature, some kind of a hard science. So we're talking physical science, engineering, biology, chemistry, computer science, software development. All of that is going to be qualified within that. So, as you can see, this is not specific to any kind of specific industry, but certain industries will lend itself to having a lot of this activity meeting this 4-part test. Some of the expenses that we use to calculate the R&D tax credit are wages, of course, some supply costs, any computer lease research, and then also any kind of contracting research that you're having a third party or other kind of contractor um, doing the research for you. So when you're all of these expenses are used to create a pool of what are called QREs, qualified research expenditures. From that pool, we can generate a credit depending on according to two different methodologies, whichever is going to work best for your clients. And certain clients are going to be able to take advantage of a payroll tax offset. This is only available for the first 5 years of the inception of a small business. That's what the qualification is. And so long as they have any payroll taxes starting from January 1st of 2023, they can offset up to a $500,000 against that. Now, so why are we discussing the R&D tax credit? Well, because we're talking about the One Big Beautiful Bill and any updates to that. So the R&D tax credit hasn't changed directly. What has happened is the way that it's applied and how it can be indirectly affected by some other provisions. So now we're going to be going to a discussion of R&D activities under Section 174. Which is very different from Section 41, which controls the R&D tax credit. So Section 174, it's a controlling section where once the Tax Cuts and Jobs Act, which was in 2016 of the first Trump administration, those provisions sunset in 2022. That meant that from that point, there were specific expenses that had to be capitalized and amortized over a period of 5 years. And that's where Section 174 outlines the types of R&D activities and expenses that are mandatory for capitalization and amortization. This is very different from what it was like beforehand, but we'll get into the history of why that's relevant. The purpose of this Section 174 and why it was even in place was one to fund the tax cuts that were being applied from the Tax Cuts and Jobs Act, and then this is not an optional item such as the R&D tax credit. This is a mandatory accounting requirement that had to have taken place for the last ever since it sunset from 2022. So the last 3 years, 22, 23, and 24, businesses have had to amortize their R&D expenses over a period of 5 years. So when you think about, are these expenses the same as the ones that are being used for the R&D tax credit? That answers a little nuance. So it's yes and no. All the types of activities that are used within the substantiating the R&D tax credit, which is Section 41, all of those expenses are encapsulated within the category of Section 174. Section 174 is much broader. It includes a lot more of the indirect expenses, such as travel. And so by doing this analysis, it requires kind of an examination of what's the difference between these two, how are they calculated, what's the purpose of this. Once those provisions from the prior act sunset, this whole calculation was, it impacted a lot of businesses very severely. If you take a look at the history of it, before they sunset in 2022, taxpayers were able to fully deduct any R&D expenses under Section 174 within the year that they were incurred, which meant a pretty good tax savings by reducing their taxable income. Or they can choose to capitalize and amortize over 5 years, depending on what their tax strategy was. Following the Tax Cuts and Jobs Act, which sunset in 2022, there was a mandatory capitalization of the R&D, which is what we were talking about, where foreign R&D expenses had to be amortized over 5 years, and domestic R&D expenses had to be amortized over 5 years, and foreign expenses had to be amortized over 15 years. This applied to all of the expenses within Section 174 that was described earlier. As you can imagine, not having that ability to use the current year deduction greatly increased a lot of the tax liability for a lot of our clients. the way that it was designed was so that after the first 5 years of amortizing, they're going to finally be able to fully realize those deductions that they had created earlier. But it really extended out the ability to take advantage of those deductions. So for the past 3 years, 22, 23, and 24, businesses have been having a much higher tax liability. Now, all this to say, the One Big Beautiful Bill took a lot of the provisions that were available in the first Tax Cuts and Jobs Act and restore some of those benefits, to so by doing that, one, they restored the immediate full expensing of domestic research and experimental costs for tax years beginning after December 31st, 2024. So there's no longer a requirement to capitalize and amortize those costs over the 5 years. Now they can do the full expensing, or they can choose to continue with the amortizing 5 to 10 years. However, because now going forward, due to Section 280C, which prevents a double dipping of being able to realize this, the Section 174 deduction that's made in that first year, that needs to be reduced by the amount of the R&D tax credit that's being taken in that year. So that's one particular thing that needs to be given a good amount of attention when you're doing this calculation. Our foreign R&D costs, that still remains subject to the mandatory capitalization and the 15-year amortization. That hasn't changed. And to provide some retroactive relief, there any unamortized R&D expenses from the 22, 23, and 24 years, now taxpayers are able to deduct those unamortized costs over a period of 1 or 2 years, beginning from 2025. And certain small businesses may elect to retroactively go back and amend those returns all the way from 2022, so that they can take those immediate expensing of domestic R&D expenses. Now,
Hey, Josh, real quick,
yes.
just a quick question here. Due to One Big Beautiful Bill changes, is amending tax returns mandatory for our clients?
Great question, Josh. Thanks for bringing that up. It is not mandatory. It's an option that certain clients may want to take, just depending on their current tax strategy. We'll actually explore those options in the next slide. It's two main options that we have here. One would be to adopt the new accounting method in 2025 and accelerate the deductions, or the second option being to elect and go retroactively apply all those R&D expenses within those years. This is the second one is the option where you would have to amend those returns. How that is actually going to be applied, we're still waiting on specific guidance for it, but we will update everyone when we have a little bit more guidance on that.
And
Going back,
Josh,
go ahead.
sorry. There's one question came in, said, who are eligible small businesses and what makes business eligible or not?
Oh, great question. Thank you for bringing that up. It's any businesses that have a gross revenue of gross receipts of averaging 31 million in the first prior 3 years.
31 million or less.
31 million, yes.
Thank you.
And so some of the so the first options, there are 3 different versions of it. First would be to just continue with the amortization that's been built up in those 3 years, and then continue with the capitalization over the remaining 5 or 15-year periods. Or they can accelerate all those unamortized capitalization within the 2025 year, which would that'll benefit some businesses if they're looking for that kind of a savings. Or they can ratably accelerate all unamortized capitalization and split between 2025 and 2026. So all versions of adopting the new accounting method going forward, with the ability to take advantage of some of the unamortized portions from the previous years. These are all versions that don't require an amendment. So that, to answer your question, Josh, those would be the options that they may want to take. And the next slide is just going to provide a, an overall pros and cons of what are the benefits of doing one versus the other. We won't go through all this, but just to keep in mind that by accelerating the amortization, you get to, you don't have to go back and amend it. You still get to maintain whatever gross R&D credits that you had from those years without making any changes to that. Downside, you're gonna have to wait until 2025 and 26 to really, realize the benefit of that, and you're gonna have to, continue that. In certain cases, you'll have to continue the capitalization of those costs that you had in those prior years. Conversely, going back and choosing to amend it, obviously there's going to be a pretty big cash benefit to going back and doing that. Downside, you do have to be very careful with how you're going to do that calculation. You have to be very mindful of that Section 280C and reducing the R&D credit by reducing the deduction by the amount of the R&D credit generated within that year. And also because all this is very new, we're not sure of how well the IRS is going to be able to respond to this, what their capacity is. So all of these things are something to consider as you talk to your tax professional about it. We are still waiting to see if there's any additional guidance that may come out within the next year, next month or so. So we will definitely update on any kind of changes or developments that happen for that.
Awesome. Thank you, Josh, for those business changes regarding R&D. If you're anything like me, you heard 641, 79, different numbers, so it's good. We'll have this replay out, as well as what on a serious note, not approaching this journey alone. It's great to engage a specialist or the firm that you work with. So with that, we'll move into our third polling question, which is, do you currently engage a third party to assist with your company's R&D credit or Section 174 calculations? Yes, we work with Hito. Yes, another consultant. Maybe your CPA helps with that filing, and maybe you're not sure. So a few seconds to answer here. We'll get our poll results up here shortly. Awesome. So with that, we'll move into our Q&A section. We did have a question that was already answered. However, it's a great question. I won't welcome you to answer additional ones, but I do want to cover a few common ones we also get that may help you as well prior to that. So while you're thinking of that and typing in the chat, one of them, what is the most common approach that clients have been taking? Is it accelerating going forward or going back and amending? So Josh, do you mind taking that question for us?
Absolutely. Yeah, and that's a great question. In most circumstances we've encountered, a lot of our clients have been stressing out about the last couple of years of trying to figure out what's the best approach. They've taken a lot of steps to, one, be able to pay their tax bill, as well as maintain the most smooth, efficient processes for their shareholders as well. In most circumstances, they have elected to do one of the accelerating options as opposed to going back and amending. I think in most circumstances that we've seen, it's been too big of a lift and not worth it to go back and do the amendment. However, every situation is going to be a little bit different. So maybe that is something that's beneficial. Maybe one of those years it would have been good to have a much larger refund for that, for whatever reason, business reason. So this will all really depend on your current tax situation, your tax strategy with your CPA. We at Hito would be more than willing to have the discussion with you if you wanted to just get a fresh set of eyes on how some of these new provisions can be used to your advantage.
Absolutely. We'll be happy to connect and help. One more question, Josh, here. So what if clients haven't filed their 2024 returns? Can they take immediate deductions or do they need to amend?
Great question. Yeah, so unfortunately, the being able to accelerate with the new accounting method, that only applies from 2025 and beyond. The current guidance is that 2024 should be filed with the old methodology of amortizing it over the specific amount of the 5-year period, and then going back and amending those. That seems like such a backwards way of approaching this. And this is one of the things that we're waiting to hear guidance from the IRS, because we do have a good amount of clients who've just kind of held a holding pattern in terms of like, is this bill going to even pass? How does that affect my current situation? We still have a couple of months till we really have to file for 2024. Maybe we'll kind of wait and see. We definitely anticipate getting some additional guidance on this specific issue, and we'll definitely update that on as that comes in. But the current guidance is that for 2024, if you have not filed yet, it still follows the older rules where the Section 174 expenses need to be amortized over the 5 or 15-year period, whichever one's applicable. And then in order to be able to realize that, going forward in 2025, either amending it or adopting the new method of accelerating those accumulated unamortized expenses.
Thank you, Josh. I appreciate that. And so as we wrap up, I want to open up for, again, any additional questions, any comments, Yuko, you may have as well, addressing our attendees here. I don't see anything pending. It looks like we've got to everything, but any last words from you, Yuko, before we present? Rick, you can move forward with the next slide, but anything from you, Yuko?
Yeah, thank you so much for joining us today. And we are planning to do these webinar, one, to give you guys a little bit update on taxes. And second, we are thinking about, inviting professional who may add to, who may benefit you for some type of topic. So we are thinking about January, we may want to do employment law updates, or end of this year we want to do maybe year-end planning and what we need to think about. So if you guys have any ideas or anything you want to learn about, please send us email, and we may put together some of the webinar in the future. But I really appreciate everybody being here and listening to our webinars. And thank you.
Thank you again for your time. Thank you, Yuko, for that. You can reach out to us here at sales@hitollc.com. If you have a dedicated representative you work with, you can email them directly or give us a call. It was great having you with us today. Thank you for your time.